of mindset, and it's great that you guys are here, right? So because it's always good to learn, and in stock market only those who learn are the ones who earn. So you really need to be a lifelong learner. You really need to be a lifelong learner in order to earn in the stock market. In order to lead a good life, you need to be a lifelong learner. And that's what you are, especially those guys who are platinum members, because you have given your commitment, you have shown your commitment that you really want to learn and get ahead in life. So just type in LLL in the comment box. LLL is lifelong learner. Just type in LLL in the comment box, and it's great that you've decided to learn here. Awesome. So let's start. Let's begin. And in order to start anything, or in order to get success in anything, you need to have the right kind of mindset. So in order to succeed, you need the mindset, you need the method, and you need the mentor. Okay, so mindset is something that you need to begin anything, right? So you need commitment to start, and you need consistency to actually finish. So you need commitment and the consistency, right? You have shown commitment by showing up live here. So let's get started. Okay, I'm gonna share my screen and let's begin. Okay, so let me share my screen. I hope you're able to see this. Okay, so we need to have the right kind of mindset when it comes to making money in the stock market, right? So what kind of a mindset should we have, right? How can we achieve the right kind of mindset, right? So let's understand the rule for the right mindset. Okay, so let's start with this, and I'm also going to share my PPT with you. Okay, now there's only one rule that we have for the right mindset. There's only one rule. There's nothing else that we need. Okay, and that rule has been given to us by this gentleman called Warren Buffett, right? Has given us a couple of rules here. I think you should be able to see it. Yeah. So there is this one rule that we need for the right mindset, and the right mindset we can get by following these rules, right? So the rule number one, so let me open it one by one. So the rule number one that we need to have is to never lose money, right? Now, is it even possible? Can we expect not to lose money at all in the stock market? Just type in yes or no. What do you think? Just type in yes or no. What do you think? Is it possible to not lose money? Warren Buffett, he's a billionaire investor, and he says that never lose money. That's the rule number one. Is it possible that we won't lose money ever in the stock market? Of course, we'll lose money at times. That he's not mentioning that. He's not saying that you should not lose even a single penny in the stock market. What he means to say is that you should not lose so much that you end this game and you have to pack your bags and you have to leave forever, right? So what he means is occasionally, yes, you lose money, but don't take so much bigger bets that it cuts short your journey and you have to really, leave this game forever. Because in the stock market, if you stay here for a longer duration, you'll start making money. Problem is, people start losing money early on, and they lose so much that they don't have any interest to pursue anymore, or they lose so much that they don't have money to invest, right? How many of you can understand this? Just type in me in the comment box. Type in me, because see, this is the biggest challenge. People come here with money and they think all they need is a demat account and some bit of money, and they can go all guns blazing, right? And they lose money, and then they blame the stock market, but they never care to learn, right? But you guys are here to learn, which is awesome. So start the stock market journey slowly, and come here to not lose money. Don't come here to make money. When you're initially starting, come here to not lose money. And if you stop losing money in the stock market, you will start making money, right? So the first goal should be to preserve what you have and not really go ballistic and start taking all kinds of trades and start losing money, because then it becomes difficult, and we'll find out why not losing money is so important. So that's what the rule number one is. Let me tell you the rule number 2. Rule number 2 is don't forget the rule number 1, which is to not lose money. So again, not losing money here is important. And there's rule number 3, which I've added here, which is to stop looking for more rules. There aren't any more rules. If you just follow this, the rule number 1, which is to not lose money, you'll do well. And I'll show you why it is important, right? How many of you, by the way, are into trading? Just type in me in the comment box. Yeah. If you're just investing, just type in I in the comment box. Yeah. All right. Right. Some of you are just investing, right? But yeah, the only rule that we need is to not lose money. And I'll tell you why this is important, right? So rule number 1 is never lose money. Always remember the rule number 1 and don't have to look for any more rules. Now, why is it important, right? It is important because if you start losing money, this game becomes difficult, more difficult, and then it becomes impossible, right? So for example, if you lose 10%, right? If you lose 10% of the money that you have, you need 11% return in order to recover the money that you have lost. I'm not talking about making money. If you lose 10%, you need not 10% to recover the money. You need 11%. That means you need more. Now, let's say you lose 20%. Well, in that case, you need 25% in order to recover what you have lost. And if you lose 50%, on the remaining capital, you need 100% return in order to recover your losses, right? And I'll give you another example here so that it's more clearer. So if you have a capital of 1 lakh and you lose 10% on it, so that means now you have 90,000 rupees. On that 90,000, you need 11% return to recover the money that you have lost. If you lose 20% out of that 1 lakh, now you have only 80,000. On that 80,000, you need 25% return in order to just recover losses. And I'm not talking about making money here, right? And if you lose 50% of your capital, God forbid, now out of 1 lakh, you have only 50,000. So on that 50,000, you need to have 100% return in order to just recover the losses. So you see, as you keep losing money, this game becomes difficult. It becomes impossible because predicting the stock market, how many of you, let me ask you this, how many of you think one can predict the stock market, what it'll do next 1 hour or by next day where the market can be? How many of you have this gift of predicting where the market can be tomorrow? Can it be predicted, yes or no? Right? First, we need to understand there are few things that we do not know and we need to acknowledge those things. And one of them is that we cannot predict what's going to happen in the future. And that is the same case with the stock market. We do not know how it'll turn out to be tomorrow, right? Tomorrow we can tell what the market will do because it's Saturday, right? The market won't be open, right? So the market won't be open. We can make a prediction that, yeah, there won't be any price movement, but can we say this for Monday? Especially now that we have this election on our head, right? That result is going to be all over the place and it's impossible. So imagine if somebody loses 50%, in order to recover just the losses, they need 100% return. 100% return on something which is unpredictable. So it is important for us to not lose money. But let me tell you what our fellow Indians are doing, right? I'll show you. I'll just show you what they are up to these days. So there was this, let me see if you're able to see this. Yeah. So there was this report published by SEBI, right? Which, they did some analysis on the people who trade in future and option and they trade aggressively. This is what they, found out, that almost 80 to 90% of the people are losing money in the stock market through their F&O trades, right? And, people from all age groups, male, female, everyone is losing money in the stock market, especially in trading, right? Not in investing. In trading, people are losing money, right? Look at this. Male, female, everyone is losing money, right? Right? Not so many females who are into trading in FNO. There are a lot of males who are doing so, right? So we can probably say that maybe females are able to recognize the risk better, and they are probably not taking too much participation. Males are taking, that added risk, and it's not really paying off, because that's what this report is saying, right? Now, who is earning then? If 80 to 90% of the people are losing money in the stock market, especially, if you look at this, that if you keep losing money, this game becomes really, really difficult, right? So who's making money? Can you guess who's making money if 80 to 90% of Indians are losing money? Who's making money right now? Yeah, can you guess? 10%? Yeah, but who are they? In Indian stock market, if 80 to 90% of the people are losing money, now we are talking about trading, FNO, future and option. If people are doing FNO, who is making money? Majority of the people are losing money, 80 to 90%. In fact, 90% or more are losing money. I'll show you. There was this report on Economic Times. Do some research on this, okay? So Jane Street, right? They are making 1 billion. And from whom? From Indians, institutional investors. Absolutely. What they're doing is, and there was this this court case by which we got to know about it, right? So go through this report, right? So you can just type in Jane Street 1 billion Indian options, you'll get to know about this. So it is the foreigners who are using all the advanced technology. They're using the algo trades to trade against the retail investors. And retail investors in India, they are ill informed. They don't even know how to trade. But as I told you, in India, all what people think is, if they have money and a demat account, they have the license to do what they want, right? And poor Indians, right? We people are losing money, and to whom? We're losing money to people who we don't even know. We haven't even seen their faces, right? It is much better to give away money to charity, right? To temple, right? To poor people who do not have enough resources, at least you'll get some blessings, right? Right now, what people are doing, they're trading mindlessly, giving people money, and those people who don't even need money, and they don't even know who they are, and in return, they get nothing, right? So how many of you agree that rather than trading and losing money like this, better to give it to charity and people who really need some resources and get some blessings in return, right? Just type B in the comment box. B is for blessing, right? Because at least we'll get some blessings, we'll get some good wishes, and at least our lives would be at least we'll feel better that we have helped people out, right? So when it comes to trading, and especially future and option trading, it is something that should not be done, especially for those who do not have time to actually do the analysis and time to sit across a computer for some time and do the analysis and take the trades and analyze the trade and monitor it, right? It's definitely not for someone who doesn't have the time for it, because the data shows us this, and clearly there are people who are foreigners who are taking advantage of the retail investors, right? So the point here is that if you're trading here, the possibility of you losing money is almost 80 to 90%. But let me tell you, if you're investing here, the possibility of you making money, especially if you're investing for long term, see, if you invest for one day, there's 50% chance that you'll probably make money, because the market can go up or can go down. So 50% chance. If you invest for a year or so, there's probably 60% chance that you'll still be able to make money. And as you increase this time frame from 1 to, let's say, 3 years, 5 years, if you are invested for more than 5 years and in a diversified portfolio, we'll talk about that in just a bit. 5 years, chances of you making money goes up to 90%. And if you're invested for more than 10 years, chances of you losing money is 0%. So if you invest for long term, 10 years or more, you cannot lose money, right? At least that's what the data says so far, right? So investing makes sense. Even if you want to trade, start by building a long-term portfolio, then look to do some short-term investment, right? And definitely, if you don't have time, don't even look at future and option, because there are, of course, few things that you can do, but you need bigger capital for it, right? 50 lakhs and above, you can do something in future and option, but if you don't have that kind of a capital, stay away. Just build wealth by investing in the stock market, right? So that's why, not losing money in the stock market is so important. And this is what millionaires actually do. They stay away from the shiny objects. They stay away from something which is in the news, right? Something which is everyone is talking about, something which is falling 20, 30, 40% every day. They stay away from these falling knives, because they know, millionaires know, rich people know, that chasing shiny objects is not gonna get them anything, right? So say no to the shiny objects. And if you start doing this, if you stop following the tips that you get, or some recommendation that you get from your friends or relatives, or something that you hear in the TV, if you put your mind to work and you start doing your own research, you'll be able to do a much better job. In fact, if you don't have the time to do the research, you don't have the time to do anything, but you still want market returns. What kind of returns does the market give? Let me get an idea. So if you invest in stock market, Indian stock market, let's say if we talk about Nifty, what kind of returns has this Nifty given in the last, let's say on an average every year? Average, I'm not talking about good year, bad year, on an average. What do you think? So about 12, 15%. Yeah, it'll be around 15%. See, Sensex was launched in 1978, and the base price then was 100. And by the end of 2023, that 100 became 72,000. It's even higher now, right? But let's talk about the closing year, 2023. It's now at 72,000 at the end of 2023. So 100 became 72,000. That means it went up by 720 times. In how many years? In about 45 years. And if you calculate, if you apply some maths here, I'll do that for you. On an average, the Sensex has grown by 16%. So the markets have given 14, 15, 16% kind of returns. And let's say if you don't want to do any research, you don't have the time and all, there are few things that you can do, right? So we'll be learning that, right? How many of you would want to get this kind of return, 14, 15% kind of returns, even if you have zero knowledge? Type in me in the comment box. So even if you have zero knowledge, but you want the market's return, whatever returns that the market has given, and what kind of returns have market given? Market is given like 15, 14, maybe 16% returns at times as well. But yeah, around 14, 15%, right? You can get that. How can you get that? We'll talk about that. Okay, superb. So all we have to do is avoid the shiny objects. And let me go here and let's talk about this. So we need to avoid mistakes in the stock market, right? Now, what kind of mistakes we can make in the stock market? Well, of course, we can do mindless trading and lose a lot of money, right? So we don't have to do that. But yeah, even if you're investing in the stock market, there are two mistakes that one can do. So let's say, I hope it's clear right now that if you trade, chances of you making money becomes really, really low, especially when we have, foreigners with all their back, institutional money and all the research team that they have, all the algo trading softwares that they have. It's difficult for a retail investor to compete against it, right? But even when it comes to investment, even when it comes to the pure equity investment, there are two kind of mistakes that one can do, right? The number one is missing out on investing in good companies. And so what this means is that you look at a good company, but you don't invest in it and it gives a stellar return. The second could be that you invest in bad companies. So one is that you miss out on good companies. Second is if you invest in bad companies, that's also a mistake, right? These are the mistakes. But what do you think? Out of the two, which is the one that you should completely avoid? Out of the two, number one or number two? Well, the answer is actually there only. Yeah. Yeah. Number two or number one? What do you think? So Beroz is saying number two. Shiv is saying number 2. Okay. Yeah, actually the answer is here only, right? Yeah. So we need to be looking to avoid the type 2 error. Now, what is type 2 error? Which is this. Now, why is it important to avoid investing in bad companies? Let's understand this. So I'll quickly open Excel here so that you're able to kind of understand this. Okay. Let me show you this. And this should give you a lot of clarity as to why saying no to a lot of things that come your way is important, right? So let's say we have like around close to 5,000 companies, right? And out of the 5,000 companies, there are 4,000 companies which are not so good to invest in. And there are about 1,000 companies which are probably good. And how can I say this? I'll show you that too, okay? So let me open up Screener here, okay? And I'll quickly show you this, okay? So what I want to do is I want to invest in companies which are giving higher returns. So I'll just quickly, put a filter here, return on capital. So I want to invest in companies where the return on the capital is probably around more than 20%, right? So let's see how many companies are there, right? So there are like 1,000 companies which are doing so, right? So out of the 5,000 companies, there are only 1,000 companies which are able to deliver more than 20% kind of returns on the capital that they're using. 4,000 are no good, right? So if I say that there is an investor who has a hit ratio, what is a hit ratio? That he's right 80% of the time. If someone is right 80% of the time, then they are almost next to God if they're right 80% of the time, right? But yeah, let's assume that there is some godly figure here who's able to predict the market 80% of the time, who's able to pick stocks 80% of the time, the right kind of companies. So what kind of company they would be investing in? How many number of companies? They won't invest in the 5,000 companies. That won't be the investment universe for them. Let's say out of the 4,000 bad companies, or let's say out of the 1,000 good companies, I'll color it so that we know, okay? So 8,000 out of 5,000, we have 1,000 good companies. 1,000 good companies. Yeah, so 1,000 good companies and 4,000 bad companies. So the hit ratio is 80%. So out of 1,000 companies, this person here will be able to invest in 800 good companies. He'll filter down 800 companies. 20% of the time he'll miss out on even the good companies. So that means out of the 1,000, he'll be able to miss out on 200 companies. He will still be able to select 800 companies. But remember, his hit ratio is 80%. That means 20% of the time he's also selecting the bad companies as well. So 4,000 into 20%. That means about 800 companies he'll still select for investment. Why? Because out of the 4,000 companies, he's 80% of the time he's able to neglect or rather avoid the bad companies, but 20% of the time he by mistake is investing in these companies. So out of the total, we have around 1,600 companies in which he would invest, right? So that means his hit ratio is not 80%, right? His hit ratio is still closer to 50%. So that means if somebody is investing and his hit ratio is 80%, even then this would be closer to 50%, right? That's something that we need to understand. And if we just understand this, that all it takes for us to make money in the stock market is to avoid the bad companies, we'll do relatively well, better than the others, right? And this is all, it's a relative thing. We are investing in the stock market, and all we need is a little bit better than others. If we have a little bit of better knowledge than others, we'll be able to play this game a little bit better. In fact, all it takes is just a little bit of edge, and you'll be able to do phenomenally well by avoiding the bad companies, right? So here, even if somebody has a great hit ratio, their overall because of the bad companies, you'll still be able to get 50%. But if you work well here, so let's say if the investing in the bad company, let's say if you drop it down to 90%, right? Let's say 10% of the time only you're selecting the bad companies. So let's say out of 4,000, you only get 10% selection here. So now out of the 1,200 companies, right, you'll be right how many times? 800 divided by. So your ratio will start to go higher, right? So all I'm trying to say here is that if you start avoiding the bad companies, you will do a lot better. And which are the bad companies? So let's look at that too. So by saying no, you can avoid the so you can avoid investing in crooks, right? Now, do you know any promoter who's a crook? Yeah, yeah. I'll show you. So let me show you this. Okay. So how to avoid the type 2 error? By saying no. And these are the things that you can avoid: criminal crooks and cheat promoters. So this probably will give you some, it'll ring a bell. So Satyam Computers, right? Kingfisher Airlines. How many of you have invested in Kingfisher Airlines? Type in I. And these are not so long ago stories. Yes Bank was another. Fortis Healthcare, PNB Housing. Yeah. Divan Housing Finance, Gitanjali Gems. Now, failed turnarounds. Again, Jet Airways, Reliance Communication, Videocon Industries. These are some of the companies that you would have heard about. Companies with a lot of debt, again, is a problem. Bhushan Steel, Reliance Communication, right? So the problem is there when we come to select the companies, right? So many: Idea Cellular, Tata Steel, Z Entertainment, Anil Ambani's companies, right? So what can we do to avoid this? See, first is the only rule is to invest in high ROCE company. But let me make it simpler for you. How many of you want to make it simpler for yourself, right? Just type in simple in the comment box. We're going to make it really simple so that you can start investing in the right manner. You don't even have to go through the hassle of selecting the companies, because a company which is good right now may not turn out to be good 5 years from now, 3 years from now, because things keep changing, right? Especially with technology, something which is doing well right now may become obsolete after some time, right? So how can we make it simple? We can make it simple by investing in something called ETF, which is exchange traded fund, right? What is ETF? Exchange traded fund. So I talked about I talked about Nifty. I've talked about Sensex, right? Sensex was launched in 1978 and has delivered around 16% kind of return in the 45 years. 100 became 72,000, right? So how can we invest in Nifty or Sensex? By the way, if you do not know about Nifty or Sensex, let me tell you about it. Nifty is a combination of the top 50 companies of India, right? Top 50 companies of India. Sensex is a combination of the top 30 companies of India, right? It's an average price of the top 30. Nifty 50, you must have heard, it's an average price of the top 50 companies of India, okay? And in order to invest in it, you don't need to invest in one company, then go to another company, invest in it, then another company, and do this for the 50 different companies. You don't have to do this. There is a simple solution for it. You don't have to invest in each company one by one. There is a solution for it, and that is called ETF, which is exchange traded fund, right? Exchange traded fund, right? Now, how many of you have heard about this ETF? Just type in me in the comment box. If you have heard about ETFs and you know what it is, type in me. And if you do not know about it, type in DNK. Do not know. DNK in the comment box. Yeah. And I'll tell you how simple your life can be, right? If you know about it. Yeah. So some of you do not know about it. Let me give you a website wherein you can get list of all the ETFs, and also you'll be able to start investing in them. Yeah. So let me share my screen again. And this is, right, this is what we are doing. Okay. So what we would do is we'll go on to a website, right? So let's do that here. Let's go on to niftyindices.com. I'll give you the link for it as well. Okay. So Nifty indices, yeah. Here you go. Here's the link, niftyindices.com, right? Now let's say you wanted to invest in Nifty 50. There are a lot of ETFs that are available, Nifty Next 50. Nifty Next 50, let's look at this first, okay? So what kind of returns has Nifty given, right? In the last 1 year, let's have a look. So let's look at the fact sheet and let's look at the kind of returns Nifty has given in the last 1 year. So Nifty has been able to deliver 25% return. And in the last 5 years, it has delivered almost 14%. Now, if you include the dividend and all, this total return is around 26%. And for 5 years, it's around 15.5%, right? So again, 15 to 16% kind of return it has been able to deliver in the last 5 years. Now you can also get it because if India is growing, the average of the top 50 companies, what do you think, will go up or will it go down? If India is growing, the average of the top 50 companies, will it go up or will it go down? It'll go up, right? Absolutely. It'll go up. And if India is growing, only then. So how many of you believe that our country, India, will continue to grow? Type in India in the comment box if you believe that our country, India, will continue to grow. And this growth in India is going to be there not just for a few years or few 1 or 2 decades. It's going to be for a couple of decades. For the next 3-4 decades, you'll continue to see India growing. And if India is growing, you'll get similar kind of returns from Nifty, right? Similar, maybe even more, right? So if you want to get returns, if your country is growing and you want to get the same kind of returns, all you have to do is invest in something called Nifty ETF, yeah, which kind of gives around 15% kind of return, right? Now, how many of you want even better, right? If you want more, type in more in the comment box. Yeah, just type in more. You say, okay, 15% is good, but I want more, right? Just type in more in the comment box. I'll tell you how you can actually do this. Again, if you are busy, you're going to office, you have a business, but you also look at the stock market and you wish that you have time, you have the knowledge to do this, but you don't need too much knowledge, right? It's like when we look at, it's really hot in India right now. And if we want to turn on the AC, do we have to figure out how the electricity work? We don't, right? We just turn on the AC. It is running because of electricity and it's cooling the entire room, the entire house. Similarly, in the stock market, you have to figure out everything. You have to find out, okay, how can I grow my money? For this, you don't have to find out everything about the stock market. You just need to know so much that it can help you grow your money. Just like you don't have to figure out how electricity work, you just need to figure out how to operate my AC. That's it. So let's learn how you can get even more, right? So let's go back to this website and all you have to do is, on Nifty indices, when you go onto this website, okay, you'll have something called indices here. And there are a lot of other indices. So Nifty 50 is the top 50 companies of India, right? And there are other other ETFs too, like Nifty Next 50, which is the next set of 50 companies from 51 to 100. So let's look at this and let's look at what kind of returns this ETF has given. Okay, so let's look at this and find out. Let's go to fact sheet and look at this. Can you see this? In the last 1 year, Nifty gave 25% return. This gave 64% return. Nifty gave 15% return. This gave almost 20% return, total returns, including the dividend. So we have another thing here, which is Nifty Next 50. So let's say roughly 20% return on an average it has given, right? Now, how many of you want even more? Yeah, we'll have some session in Hindi sometime, sure. Yeah, how many of you want more, right? Just type DMM in the comment box. DMM is Dil Mange More. Yeah, just type DMM in the comment box. I'll tell you, you can even get more, right? Again, I'll talk about the risk again, right? Later on, how you can actually put everything, in place and then also take care of the risk, Okay. Yes. So let's learn more. Okay. Because you got to learn more in order to earn more. So let's go back to Nifty indices and let's go here and let's look at some other strategy indices, right? So let's look at, let's say, Alpha 30, right? So I'll click on this Nifty 200 Alpha 30. Okay. So whatever we are discussing, you'll have to do your homework. You'll have to research more. Don't just think of this as a recommendation to you. It's not. You have to do your own analysis. I do not know what your financial situation position is. You have to do the hard work. You have to do the analysis. You have to do the homework to find out whether this is suitable for you or not. The risk is always there. Yeah. Okay, let's look at this one. Nifty 200 Alpha 30. Now look at this. Last 1 year return has been 81%. But see, last 1 year, everything has gone up. So of course, we won't go by just 1 year. We need to look at 4-5 years return, because 5 years would have good year, bad year, average returns. And we need, good year, bad year, and we need to look at the average. Because if we only look at good times, then we'll probably be misled. Okay, so let's look at the 5 years, because 5 years would also have the pandemic period and all that, right? So 5 years return for this has been 26%. Total return has been closer to 28%. So we have another one here, right? Alpha 30, right? This has given how much? Roughly around 28%, right? So let me write it here, 28%, right? Now let's take one more so that, we have, one more ETF that we can look at. Probably you can have 5, maybe 6 if you want, right? Not 3. Let's have one more. So let's go to Nifty indices and let's go for something which is in mid and small cap space, because we also want to get higher returns, because mid and small cap can give higher returns, but they carry higher risk too. So bear that in mind. Okay. So, but yeah, let's have a look. Fact sheet. Let's look at the kind of return it has given in the last 1 year. It has given 58%, right? But total return in the last 5 years on an average has been around 25-26%, right? So let's go back here and let's look at mid cap 150. The return that it has given is closer to 26%. Now let's say if we don't know anything, we know that ETF is a combination of some companies, and let me show you. For example, here, this is a combination of the top 150 mid cap companies, right? We also looked at, let's say, we were looking at Alpha 30. So let's look at what this stands for, right? What is the methodology of it? You can actually get to know all of that here. You can click here and get to read more about it. But yeah, as I said, we don't have to actually find out everything, right? So for example, here it says Nifty 200 Alpha 30 index. It is it consists of 30 stocks selected from the top 200 companies, and based on the Jensen's alpha, right? You can get to know more about it. I don't want to get into detail because I really want to keep it simple. You don't even have to find out what the methodology is. You just have to look at the overall returns, right? Compare it with a few other ETFs. Look at the expense ratio. How much is it charging you? Won't charge much, maybe half a paisa, probably lesser than that, mostly less than half a paisa, and you get these kind of returns, 27%, 26% kind of returns, right? Now let's say, I'm not again suggesting that you should do this. If you want to do this, it carries risk. You got to do your own homework. It's not really a recommendation. Let's find out, let's say if you have done this, on an average, what kind of returns will we get, right? If you have an equal weighted portfolio, let's say you put whatever money that you have, you put 25% here, 25% here, 25% here, another 25% here, right? So what kind of a returns will you get? Well, I'll simply add this and divide it by 4. I'll get the weighted average return, right? So I would simply take the average here. And if I take the average, about 22% return. Now, what does 22% mean, right? We need to find out what does it mean. So whenever we are looking at returns, we need to find out how much time will take me to double my money. And there is something called rule of 72 that we can use that can help us find out how much time will take us to double our money. So simply divide the number 72 by the rate of returns, you'll find out how much time it'll take you to double your money. So 72 divided by the rate of return, which is 22% on an average. And this can fluctuate. It can be even higher, can be slightly lower. So it's not fixed, right? So 72 divided by 22 is, in about 3 years, you'll be able to double your money. How many of you would love it? Just type love it in the comment box. How many of you would love it if you can double your money every 3 years? Because you know what that means? That means that if you have invested 10 lakhs, right? Every 3 years it's doubling. So we got 0, 3, 6, 9, right? So we're starting with 10 lakh at the 0 year mark, right? If it doubles in 3 years with this kind of return, it'll be 20 lakhs. Another 3 years, it'll double again, it'll be 40 lakhs. Another 3 years, it'll double again, it'll be around 80 lakhs. And one more year, we have 10 years, right? We're talking about 10 years. If we do it for 10 years, right? So 10 lakh in about 10 years, how much will it be? So 80 lakh, let's say growing by another 22%, 1.22. So this will be close to 1 crore, right? So we started with 10 lakh. Because of the power of compounding, we can actually grow it to 1 crore, right? And what are we doing? We are just investing once. And if we keep investing regularly, let's say every month, keep adding on to it, you can actually go and achieve your financial freedom in the next 5 to 10 years, right? How many of you would want that? Just type in FF in the comment box. FF is financial freedom. Yeah. FF is financial freedom. It is not something which is too far-fetched. You just have to first understand that you don't have to figure out everything in the stock market and only then you'll be able to do something here. You just need to know enough to to get the compounding working for you, because the power of compounding is there in the stock market, and this is the power of compounding. You start with 10 lakh and without adding any more amount, because the money is growing, the next time when it grows even more, you would get return on return, right? That's the compounding. So simple interest is, you have invested 10 lakh and every year, let's say if you're getting 6% return, let's say on fixed deposit, you get 60,000 rupees every year. That amount won't grow. It'll be 60,000 every year, right? Because you're getting the return only on 10 lakhs. But here you get return, interest on interest, right? So 10 lakh becomes 20. Next time when it doubles, it's not that only 10 lakh will be added to it. 20 lakh will double, right? Then 40 lakhs. Next time, 40 lakh will double. And that's the power of compounding here. Just type in POC if you got that, right? Just type in POC. Yeah, there is actually no guarantee in the stock market, but as long as you believe that our country, India, is growing, that is the guarantee, right? See, you have to be optimistic about the future. Only then you'll invest in equity market. What are you doing when you're investing in a business? You're optimistic about the future. Let's say if you're not optimistic about the future, why would you even invest in something called equity market? You'd rather be investing in a fixed deposit if you're not very sure about, or let's say you're not optimistic about the future. If you think economy is going down the drain and in the coming few decades India is going to go down, of course you should not really be investing in the stock market at all. But if you think India is growing, if you think that the place around you, the city or the town that you live in, has seen development in the last 5-10 years, so of course India is growing, and it has just begun. Coming 10, 15, 20 years going to be amazing for the Indian stock market, and you should, I think, learn more in order to earn more. How many of you would want to learn more? Just type in I in the comment box. If you want to learn more, type in I in the comment box. Yeah, because see, especially in the stock market, if you are learning, that's the only time that you will have a good chance of earning, right? Otherwise, it is actually difficult. Yeah. Okay, superb. So because you've shown interest in learning, what I'll do is, okay, so what I'll be doing is, okay, yeah, I we'll be giving you a link here, right, so that you can learn more on this, right? There is yeah, so there is a free class that I would want you to attend, okay, so that you can learn more of this. How many of you would want a free class? Type in me in the comment box. Here you go. Here is the link. All right, I think yeah, you should be able to get it. Yeah, it's a free class that you can learn more from. Yeah, awesome. So somebody's talking about corporate bond. Yeah, so yeah, corporate bond, especially at a time like this, it could be a good bet. Corporate bond, gilt fund, because as the interest rate comes down, maybe 6 months down the line, this can give you great returns, right? And when I say great returns compared to fixed income, not equity investments, right? So yeah, you can get better returns than fixed deposit, probably double digit returns too. But yeah, it cannot be compared with the equity return, because the kind of returns that you can get from equity, it's unparalleled, right? Because I've just showed you, if on an average 5 years average you get 5%, 20%, 28% kind of return. Now you probably would say, why don't I put all the money here if it's giving the best returns? We need to manage the risk here, okay? We need to ensure that we are investing wisely, and these are not the only ones. You can actually look at some more ETFs, right? in fact in fact, what I'll do for you is, right, how many of you would want a gift, right? I'll show you the gift that I'll give you, okay? Yeah, just type in gift in the comment box. Yeah, so one gift I've given you is this. You can attend a free class, right, by logging on to this, and I'll give you another gift, okay? And that gift is this. Especially those who are attending this free class would definitely be getting this, but yeah, since you're here, you'll also get it. And that gift is here. I'm going to give you a list of stocks, right? List of the top 100 most profitable companies of India. I'm sure some of you here want to invest in direct equities, right? You want to invest in direct stocks. So I'm going to give you a gift here. So it's a list of the top 100 companies, most profitable companies of India. In fact, you'll also be getting a position sizing calculator. So let's say what you do is, if you want to invest, let's say you want to invest 3 lakh rupees in a stock that is trading at, let's suppose, 290 right now, and you say, okay, it's trading at 290. If it drops to 250, I'll exit. So that's a loss of 40. So if I'm not looking to risk more than, let's say, 2%, how many number of stocks should I be buying? It'll calculate that for you, right? Look at this. It'll calculate. Now, let's say if you say, okay, I'm willing to invest 5 lakh here. If I'm buying at 290 and I'll exit at 250 if it's wrong investment, how many number of stocks should I buy if I don't want to incur more than 2% loss? It'll calculate that for you, right? So it'll become easier for you to invest, and then you can invest with no tension, because you would know that I'm not risking more than 2%, or you can even select some other amount that you want, right? But yeah, this way you'll at least know how many number of shares you need to buy. And this list will also give you a list of the companies, and you can build a well diversified portfolio from here. It has some banks, some IT companies, NBFCs, paint, steel, cement, a well diversified auto sector is here. You have tea, IT, life insurance, hospital, right? You'll be able to build a diversified portfolio with this, and I'll show you, right? I'll show you the kind of returns that you can get by investing in good companies, right? So what kind of returns has Nifty given us in the last 1 year, right? So let's look at that right now, okay? So we'll check that out live just now, okay? So let's check out what kind of returns has Nifty 50 given in the last 1 year, okay? So last 1 year, Nifty 50 has given closer to 22% kind of return, right? 22%, right? Now, if you're wondering how it was 25% earlier, that report was till April, that is last month, okay? So that was 25%. In the May, because of election tension, the market has corrected a little bit. That's why the last 1 year return has been 22%, 21%. And if you look at the returns for some of these companies, look at this, right? If you knew nothing, but all you did was you selected the top 10 companies, right? And if you would have invested in the top 10 companies, what kind of returns you would have got? You would have got 23% return. And this is the live prices that I've actually calculated for you just now. Okay. So this is compared to 21%. You would have got more than Nifty returns by just doing this, right? Now let's say instead of 10, you would have invested in 15 companies. What kind of returns you would have got? I'll just take an average of this. Top 15 companies, most profitable companies, almost 21%. Let's say if you would have done it in the top 20, right? Let's look at this average of top 20 companies, most profitable companies, more than 21%. You would have easily got closer to 30%, right? Now let's do one more experiment. Now let's say what you would have done is you would have, instead of investing in the top 10, you would have invested in the next 10 companies from 11 to 20. So let's find out what kind of returns you would have got. Average, you would have got 35% return, and that too when one of the stock went down by 17%, another stock went down by 13%, one more stock went down by 44%. But look at the other stocks, right? Now if you can learn something by which you can invest in better companies, you will be able to pick better companies. Now look at this. Even if you are blindly doing this, right? Even if you were blindly doing this, top 10 has given more than 21% return. Top 15 has given again more than 20% return, right? But if you were looking at the companies and selecting the companies on your own, you probably would have done even better. But let's say you don't have the time. All this requires knowledge. You need to learn in order to do this. But if you don't have the time, I've given you a solution today. Okay, how many of you got the solution of investing even if you don't have time? Just type in solution in the comment box. Yeah, yeah, yeah. Here you go. Yeah, just type in solution in the comment box. The solution, again, if you have just joined and you are not aware what I'm talking about, we talked about ETF, exchange traded fund. You don't have time, you don't need to look at all the companies, analyze, and then worry about whether you have invested in the right kind of companies or not. ETF is a good solution for you, and I'll tell you why. Okay, so I'm going to close this with this statement as to why this makes a lot of sense. Right now, ETF, what it does is it is an average price of some companies. Right, which companies are these? These are the companies like Alpha 30. These are the top 30 good performing companies based on some parameters, right? Again, you can go deeper by looking at the methodology. But what it does is it will contain only those companies which are the top companies. So if we talk about Nifty 50, right? Nifty 50 is a combination of the top 50 companies of India. Yeah. Yeah. Top 50 companies of India. Yeah. And what I'll do is I'll just explain this point to you so that you are able to understand this, right? So Nifty 50 is a combination of the top 50 companies of India, right? And if one or two companies are not doing well, they'll be moved out of the index and some new companies will replace them, right? So what it means is that those 50 companies will always be robust companies. They'll always be top companies which are performing, which are doing well. So this group will continue to do well. Of course, there'll be times when some companies will not do well and they'll be moved out. So it is like a classroom which is of top students, right? And if one or two students are not doing well, they'll be moved out of the class, and some bright students will replace them. So the result that this class will give will always be the best. So you don't have to worry about what if this doesn't work, because if this is not working, the whole India is not working, right? And that's not going to happen. So if India is growing, this will work, right? And what can you expect? On an average, it has given 15-16% kind of returns. You do all this, most likely, of course, there's no guarantee, most likely you'll probably be able to beat this and get better returns. Yeah, right? So how many of you now think, with whatever little that I've taught you right now, of course you can learn more, that you are somewhat ready and you believe a lot more in Indian stock market, right? Just type in ready in the comment box. If you're a little bit more enthusiastic, or let's say you believe in Indian growth story, or let's say you believe in Indian stock market a little bit more now after what I had to say in the last 1 hour. Yeah, just type in ready in the comment box, because really I want you to start looking at this seriously. And again, the thing that we have discussed today doesn't even require too much of an effort, right? You can, in fact, let me just share my screen again, right? Yeah, so these ETFs, right, you don't have to invest 10 lakhs. You can invest 5,000 and keep investing regularly. You can build your portfolio slowly, like slowly and steadily, because this growth is going to be there for decades. Okay, so you don't have to invest 10 lakh in one go. You can start with 5, 6, 7,000. Just invest regularly. And if you can ensure that you invest regularly and not just invest one time only, you'll make money here. Okay, awesome. Right now, if you have any questions, guys, feel free, right? Feel free to type in your questions if you have any questions. I'll spend like next 5-7 minutes answering questions. And yeah, okay, so I've invested in 21 companies and doing very well. Okay, that's very good. Congratulations, amazing. Yeah, yeah, you'll get that, right? I'll ensure you get the Excel sheet. Absolutely, sure. Okay, so you missed the session. I think you can get in touch with Indu and Mitesh, and they'll be able to help you out. Please send them an email. They'll be able to help you out. Awesome, super. Right. So, all right. So, can I can a novice become an expert here? Yeah, of course. It requires some time. All you have to do is make sure that you learn 15-20 minutes, half an hour, maybe more if you can, but at least 15-20 minutes, half an hour every day, because every day when you're learning, you're getting better. You're better than what you were yesterday. And tomorrow, if you learn more, you'll be better than what you are right now. So every day, if you keep learning, you'll keep making progress. Awesome. Yeah, even if you're new, you'll be able to learn all of that. Gold ETF, yes, that's also there, right? Gold ETF is there, and you have other commodities as well. Yeah. Is there a way to do profitable trades in options? Yeah, you can do it against your portfolio, and maybe we can have another class for this. But the safest way to do it is against your portfolio. Yeah. Do you use sentiments to decide which stocks to avoid or buy? Well, not sentiments. You'll actually look at hard facts, which is you'll be looking at the company's data, whether it's making money, whether how much debt it has, all those things, right? What kind of a future it holds, how to proceed. Yeah, start with start with this class. That's how you can proceed. Gilt ETF, gilt is a government issued long term, right? It's like a loan to the government. Okay, but yeah, it's like a debt instrument, debt investment. It can go up and down a little bit, but yeah, most likely, you'll be able to make returns in it if you get the interest cycle right. Interest, if it's going down, chances of making money are more. Okay, difference between Nifty, Gold, Gilt, ETF, please. Yeah, sure. Uh, you know, Nifty is equity investment. Gold is commodity, right? So it depends on the gold price. Nifty 50 depends on the Nifty 50 companies. Gilt is government issued long term. As I said, it's the debt fund. Okay. So can we have list of stocks? Yeah, you'll get that. When do you sell a stock after buying? Well, you sell a stock if you need money. That's one thing. But yeah, let's say if you're just looking at the company, whether it is time for me to sell or not, will depend on whether you have a better investment opportunity available, or let's say if the fundamentals of the company has changed, right? Let's say you invested in a company based on some thesis and that is no longer valid anymore. That is the time that you would want to exit from it. Yeah, or it has become insanely expensive. That's another time that you would want to exit from it. Okay, should we invest now or after the election? Well, in case if you have not invested so far, then might as well wait for a couple of days rather than taking a bet which can be extremely risky. Okay, awesome. So I think that's about it, guys. I think I'm sure you have a lot of questions, but we would be meeting again, and we'll carry on. And yeah, here's the link again if you want to attend that free class. All right. So thank you so much. Take care, everyone, and I hope this session kind of convinced you, and I was able to nudge you a little bit, in investing in the equity market, because it is much needed. Maybe your future generations, in case if you don't invest, will ask you as to why you did not invest in the equity markets when it was available at such a good level. We are at 23,000 when it comes to Nifty. 10 years ago it was closer to 5,000, 6,000 levels, right? So yeah, investing always makes sense, especially the long term investment. Okay, so keep learning and keep compounding. Thank you so much for joining in. Take care, everyone. See ya. Bye bye. Take care.